Hi there, it's Geoff here. Let's have a quick look at the difference between disinflation and deflation. Now, disinflation is a fall in the rate of inflation. So whilst prices are still going up, they're doing so at a slower, a weaker pace than before. So if the inflation rate falls from 5% to 3%, we still have inflation, but disinflation has occurred. And typically, disinflation is hopefully a controlled and temporary slowdown in inflation due to deliberate policy actions. A good example is what's happened in the UK in recent times. Have a look at this chart showing the inflation rate in the UK since 2000. It goes up and down, obviously, but we've had periods of disinflation, for example, after 2022. So the rate of inflation in the UK rose to over 11% at the peak of the cost of living crisis in the summer and autumn of 2022. And since then, the rate of inflation has come down. It's come down to just below 2%. It's now actually rising back up to 3%. But disinflation is what we've seen in the last 18 months. Now, prices are still going up. The cost of living crisis is not over, but the rate of inflation has fallen. Whereas deflation is a negative inflation rate, a sustained decrease in the general price level for goods and services. And in this scenario, prices are not just rising more slowly, that's disinflation, they're falling. That's price deflation. Typically, not always, but it's a result of a deep economic downturn or some sort of major economic shock, a deflationary shock, perhaps the consequence of a sudden and big fall in the prices of many financial assets, including stocks and shares and housing. Japan is a country which for many years has been either on the edge of or experiencing price deflation. One measure is something called the GDP deflator. It is a measuring of inflation. And we've got 30 years of data here. You can see that in many of those years, from late 1990s onwards, Japan had deflation in their economy. Just recently, inflation has returned, and the Japanese regard that as welcome news. In fact, the Japanese central bank has brought an end to its negative interest rate policy because of the return of inflation to 4 or 3%. These were the countries in 2023 with the lowest inflation rates. So the likes of Costa Rica and Oman and Thailand have very low inflation at or around 1%. But that's not deflation, that's just low inflation. Whereas Turkmenistan, Yemen and the Seychelles did have negative inflation. So we could say that they had experienced deflation in 2023. Of course, the key thing is whether that deflation persists, as it has done in Japan, or whether that deflation, for example, in the Seychelles, is a temporary event caused by a variety of supply and demand side factors. Disinflation normally happens when central banks have increased interest rates. They've tightened monetary policy. So in the UK, interest rates went up to 5.5% over a period to help bring down the rate of inflation with a lag. Debt levels not normally a factor in explaining disinflation. And when disinflation happens, there's less risk of a wage price spiral because workers probably won't ask for or try to bargain for significantly higher wages. So wages may grow at a weaker pace. And often disinflation is a result of an unwinding of supply chain factors. So during the pandemic, we saw a lot of supply chains getting disrupted, and that caused significant increases in costs. But as supply chains improve, that reduces cost pressures, and then, hence, the rate of inflation can come down. Whereas deflation can often be the result of monetary policy being out of step. You keep interest rates too high for too long, or perhaps fiscal austerity is causing the deflation, where governments are cutting spending or increasing taxes and taking demand out of the economy, and that is a risk of causing demand-led price deflation. The main cause of deflation is the aftermath of an economic and a credit boom. I've put there on my table high debt and deleveraging cycles after a credit boom. Basically, if we think about the subprime crisis in the States, if we think about lots of credit booms that have basically gone wrong, in the event of that happening, banks stop lending, individuals trying to save more, businesses trying to repair their balance sheets and reduce their debts. All of these factors reduce demand and output and income in the economy and can cause price deflation. In that situation, wages often start falling in nominal terms. People have less money in their pockets to spend. Companies are shedding labour And we often find in a period of deflation, unemployment goes up, and that can worsen the problem, can't it? Because if unemployment increases, people have less money to spend, so the deflationary forces can deepen. But on the other hand, deflation can be caused by positive factors. So, the cost of using and buying technologies might fall. Technologies can drive higher productivity, shifting out supply. Now, these are factors driving down costs and driving down prices, and they could cause price deflation. But that's a much more positive cause of what we see. There we go, a quick look at the key difference between disinflation and deflation. Students often get those terms confused, but I'm sure you won't do that in your exam.